What's up, guys? Your agent Tyler Wayrung here, and today we're going to be giving you guys another update on the Heights on Katy, or the open door capital funds that I've invested in with Brandon Turner. So if you're not familiar, check out this playlist up here, and I'll walk you through my initial investment with him from his very first investment, Fund 1, all the way up to my current investment today. And we're going to be specifically diving into the Heights on Katy fund in this video, walking you guys through a 2023 year-in review for an asset that has not done very well, if I'm just being blunt. So we're going to walk all through that. I'm going to first jump into my screen, walk you guys through their exact update that we received, and then I'm going to show you some data that I've extrapolated and kind of walk you through my thoughts, some of the questions I still have, some of the things that I actually do feel a little bit better about, and then we'll end with a big question mark for the future going from there. So with all that being said, let's go ahead and dive into my screen, and we'll first start off with the 2023 update. So from Heights on Katy perspective, remains stabilized as we close out Q4 and head into Q1. We remain focused on maintaining strong occupancy and collections, looking for opportunities to grow revenues. As previously mentioned, now that the asset is stabilized, the next big opportunity to push income is focusing on other income, most notably leasing remaining storage units, reserve parking, and introducing new fees. I'd love to know a little bit more about what those things are and why we're just starting to look at those. We've kind of been behind projections for quite some time now. So if these have been opportunities, that'd be interested to know about. This will be a continued effort over the next several months to better position Heights on Katy for a refi. So a refi is something they just started to tease probably over the last quarter of 2023, but you'll hear more about that in this update. As we approach the upcoming refinance at the end of the year, we will begin to model where NOI is trending, what expected refi options look like, and what additional options, if any, management will leverage to work towards a successful refinance. Okay, Heights on Katy ended December with $604 in revenue, with an impressive 102% rental income collection for the month and 93% occupancy. Aligning with the targeted budget Q4, we've remained in budget. So basically, this just covers this graph here. It's just walking you through that in words. But so I'll quickly touch on that. So target occupancy has always been 95%. As you can see, we hit that a couple times through the year. You'll check out just in a minute here, but we ended just below. Revenue was actually pretty close to target. NOI and year-to-date NOI, both 10% below projections there. So I'll quickly touch on distributions, then we'll hop back up into some data. So really no changes here. They're just mentioning, hey, with previous updates, I think they told us that back in February of last year that they would stop distributions because of the insurance and other costs that have bumped up $70,000 per month. So with that, no changes on that, but I've essentially, what we're going to do now is take a quick look at the month-over-month changes in this little graph right here. So obviously they just give you the end of year for 2023, but I think it's helpful to look at each month so we can look at trends, see how things change month to month, and really just relate that data. So what I've done is essentially just put all of that, all the monthly updates into Excel so we can start to break things out and look at them a little differently. So basically what I've done here is put the values up in these first four rows and then the projections down here, just to kind of break those out separately. But as you can see, it lines pretty much up with how they do in their monthly reports, but just being able to look at it in a month-over-month perspective there. So I also put the averages over here just so we can kind of see how things are aligning to the average and where those are. Of course, year to date, doesn't have an average, right? It's just a rolling or cumulative total each month. So the way we're going to do this is, and something I like to do in Excel because I'm a very visual learner and just a data nerd in general. So if you fall in that camp, this may be helpful. You probably didn't know you were getting an Excel course, but this is a quick tip here. So anytime you really want to look at data and relate it to the rest of the data in a selected range, you can do that very easily and very visually appealing through something called conditional formatting, where you just click here, click color scales, and then green on top will be green being your highest value. So it quickly shows you just It highlights your highest values in green and then down to your lowest in red, and a scale for anything in between. So as you can see here, we can quickly tell, hey, the second half of the year went much better than the first half when it comes to an occupancy perspective. It highlights our lowest values down here at 89. We had 2 months at 89 in the red, and then our top 3 months where we strung together right at the target 95% occupancy over August and through October. So not a whole lot here. I mean, nothing big spikes one way or the other from the budgeted 95%. However, I would prefer to see this, green more recent than the red. So good that we're kind of trending more in the green towards the second half of the year versus look like, we were pretty rough those first 6 months of 2023. So again, average throughout the whole year was 92% from an occupancy standpoint. But now let's take a quick look into revenue. So we're going to do the same thing here. Just kind of look at that from a color perspective. So very similarly, never been known for my public speaking abilities, but again, from August through the end of the year, we're trending, from low 600s to 611. We got up to, which is great, very highly, very much above the average there. But first 6 months of the year, again, from an occupancy and revenue perspective, not so hot. So good to see that we are trending in the right direction there, but some of the things that I would be interested in knowing if I were putting this report together would be, hey, what happened between July and August? Nothing from an occupancy standpoint. So we didn't get a whole bunch of new renters in at, do we raise rents? But we've jumped a pretty significant amount in total revenue. So that's something that might be interesting to look at from that perspective. I went back and looked at the report. I think all I saw was that they were shopping insurance, but I wouldn't expect that to show up on the revenue side. That'd be more of an NOI thing since we're paying an expense there. But for what it's worth, I do appreciate the fact that we are trending in the right direction there. In fact, I did put a quick little graph together here for revenue specifically, just because it is one of the key indicators here. So this is just month over month graphed, just to see that again in another visual with a trend line there, again trending in that right direction, up and to the right, which we would like to see. All right, so now let's look at NOI. This is just about the same, not as big of spikes, but we do see May and June being some of the two worst months, actually very similar, very close, within a couple $100 of each other, being those worst 2 months. I would like to know more about that because they were pretty significantly lower than the average and the rest of the other months there. So when just looking at that, those kinds of things jumps off the page when you see that with this visual color scale. But again, from a bright side, we ended the year with the highest NOI that we had throughout the entire year. So from a trend perspective, that's something that is good to see, right? Want to be trending in that, and hopefully they can keep that going, moving forward there. But hopefully that just gives you some perspective. And for those of you not familiar, NOI is really the most important thing on this whole sheet. The only thing that really matters when we go to exit this is the NOI, right? Net operating income is how commercial assets are valued. Conversely, from residential, where we look at comparable properties. So in commercial space, two properties can be right next door to each other. One produces vastly higher income than the other, and it's going to be able to sell for a vastly larger amount. So from that perspective, year-to-date NOI is typically what we want to look at, because anyone that's going to purchase this is going to want to look at the trailing 12 months or the T12s and trying to do their analysis off of that is probably going to how they're going to come up with their value. And so that's the big number there. So I won't do a color scale on year-to-date because, like I said, this is cumulative. Every month it just continues to add on to the next. So it is kind of interesting to see, if we look at the year-to-date projections from a scale perspective, we can see that, obviously we started out pretty much right at budget because we did have that first good month. But again, as we saw throughout here, June and July were pretty rough. I mean, things, at that point, I think several of you guys did reach out to me a little bit worried, like, hey, we are not trending in the right direction. What the heck is going on here? So glad to see that we did turn that ship around a little bit, at least a little bit away from the trend, continuing to get worse, and ended the year at 10% below projections. Okay, so again, going back to communication, I think this is a very key data point that they could elaborate on. And I think it would only behoove them to show, hey, look what we did. We turned this thing around. But let us know a little bit more of what did you do? How did we do that? And can we do some more of it? Right? That's the thing I'll just continue to knock them on. I mean, a whole year update in 2 paragraphs. I just don't think they, really spend a ton of time putting these together. And especially for an asset that's, I won't say in distress, but definitely not living up to the expectations here. I would like to see a little more effort from the team to kind of show, hey, here's what's going on. Here's all the things we're doing. But as you can see, they did do some things right to turn the ship here, which I thought was a good sign, right? So hopefully we can continue to keep seeing that moving in the right direction going into 2024. But just a couple other things that I do want to dive into here. And again, if you really like these numbers here, you can pause the screen and dig into those, but essentially just pulled those out of the monthly updates. So a couple other factors when we just kind of look at where we are from an NOI standpoint and some of the value pieces here. So from a year-to-date NOI, obviously we were 10% off of the target or projected NOI. So I just kind of did the math to figure out, okay, what was the target NOI? It was, I put that here. And so how much were we short? We were short, 323,000. And from a monthly perspective, 26,000. So as you can see, going back, looking at NOI, they fluctuated pretty heavily. So it does make me feel a little more optimistic that, hey, if we can just bump this up 26K over the next 12 months, we'll be right back on track. So from that perspective, I think, it felt a little bit better to see than just being 10% below projections. So, however, with all that being said, from a cap rate perspective and valuing this asset, this is something I'm a little concerned about. So before I jump into the math here, let's pull up this email here. So I did find the original email sent to me on December of 2021 when we closed on this asset. And just to give everyone some perspective on kind of where I'm coming from here. So, hey, investor, we're thrilled to announce our newest investment. It was Cheval Apartments. They've rebranded it. This is 387 unit A-class apartment complex in Houston, Texas. Okay, that doesn't really matter. Okay, so Cheval is a $70 million 387 unit class A, whatever. They just continue to go on here. Okay, so I read this as, Open Door Capital paid $70 million for this asset. If we take their target NOI and do some very, I'll say, conservative for them cap rates. I did just some quick Google research on cap rates in Houston. 5.5 is probably more accurate, but I tried to give them a little bit favorable value here. So even at this target NOI at a 5% cap, which if you're not familiar, the lower the cap rate, the higher the value. So obviously you would want a lower cap rate. That puts us at a $62 million valuation at last year's target. So if we paid 70 and our target is 8 million less than that, and we're below our target, yeah, I don't know. I have some questions there that I think, are perfect items for them to be able to elaborate on. I think that's something that should be a little more straightforward of like, here's why we came up with that projection. Maybe, this is a 5 to 10 year hold, so maybe they're going to gradually increase that target NOI to get up to something higher than that. But at the same time, then I'm wondering, well, why'd you just pay $70 million for this thing that we just dumped all this money into? And we're still, this is at our target. This is at our actuals. So our actuals are probably much less than that. And if we use a lower cap rate, we're significantly far off of $70 million. So my hope is, and if you're in any way involved with ODC, please comment below. My hope is, and this is not sure here, but my hope is that this $70 million includes purchase price and the CapEx raise that they took from investors to put all this together. However, if we're still out 70 million on this property and, our value is still not very close to that, obviously that's a little scary. A couple other things I just thought, maybe, I don't know, looking at it now, I'm sure they would probably have adjusted this too, but what we love most about this deal is the risk-adjusted returns. This is a 25, the way they kind of word this is, hey, there's really no risk here. I mean, we've kind of accounted for everything. Look at all these positive things. But there was one or two things that changed this whole deal around that I feel like we did not give any respect towards when evaluating these. So, and that's interest rates and insurance, right? I don't know what we could have done, but I feel like if you're going to buy something for $70 million, and those two potential variables are out there to kill a deal, may have wanted to give those a little more weight and at least call it out here. Like, hey, if this happens, it's not going to be risk adjusted. This isn't just everything's going to go perfect here. So maybe for those folks out there considering jumping in, maybe just read these investment highlights in these future funds with a little more caution, that these are marketing materials. These are not an investment prospectus, if you will. So, again, these are just some other details about the deal. It was a hold for 5 to 10 years and then exit after adding significant value and implementing a target capex. Yep. So I don't think any of that matters. So my only other piece that I just want to call out for perspective is we're doing all this. We're targeting for a refinance in the end of 2024. So one of the things that I think they should touch on is, in the original investment docs, it says that the syndicators or the general partners of this syndication get a refinance fee for putting one together. And I feel like since the investment, which normally, there's a lot of work involved with that, I think they should get something. However, if we put all this together and it goes off the rails, to still take that full fee from the limited partners, that doesn't really sit right with me. That's not how I would conduct business if I were in their shoes. I feel like a little give and take would be helpful there. So I'd love to hear a little bit more from them about that, about any considerations or concessions they're willing to provide, because this thing hasn't gone like we all thought it was going to do. And again, I mean, they got skin in the game here. They didn't expect it to go, but at the same time, to continue to fee us to death, I think that's one thing we need to know about. And two, how is this refinance going to help this situation that we're in with this increased expenses? Are we just, are we extending the term on our current note? Because when we refi, I can almost guarantee we're going to get a higher rate than we're at now. So let us know a little bit about what the plan is. Like, how did you land on the decision to refinance? And what is our hope? Like, is there metrics we're looking at? Hey, we're going to refinance only if we can do X, Y, and Z. I don't like just the blanket, we're going to refinance, and that's going to solve all of our problems. So I would like to hear more about that. And thirdly, I think you guys owe it to us to say, I mean, you do give year-to-date NOI, but what kind of cash reserves are we sitting on here? I know several passive investors have reached out to me a little concerned, especially in those last summer when we're looking at these really ugly months here. They're worried about, are we going to lose this asset altogether, right? I mean, I think we're in a much better position than that. I mean, you can see here the property is producing healthy NOI. I mean, to at least hold it. I don't think we're at risk to take that, but I think we should owe it to us to at least say, hey, this is the total cash reserves that we're sitting on. We're in a very financially strong position here, but we just want to continue to not distribute anything out because we want to keep this thing in a strong position. I mean, just a little more details around that, I think would be very helpful to know kind of the true health of the asset and make folks sleep a little bit better at night, just knowing, hey, this didn't go as planned, but we still have a plan to make this a success based on all the variables that we're up against. But here's exactly where we sit with everything there. So All right, those are my thoughts. I know I kind of went on a couple rants there, kind of dove in a little deep on the data, so I apologize if that's not your cup of tea, but for me, that's how I evaluate, and I thought the only way to do this is just to be transparent and read this, be vocal about exactly how I'm feeling, so that you guys can at least drop your different perspectives down in the comments. So I know a couple of the ODC folks do watch these. So if you guys have thoughts, please share them below. I do appreciate you guys have been great about communicating and reaching back out directly to me to answer questions. So I do appreciate that. I just think there's a couple other things, and I know you guys have a ton going on, but again, I feel like sometimes we get a little bit forgotten about and shuffled in with all the other deals that Brandon likes to throw around on Instagram, rather than, you know, show us some love too. You know, that's how I feel. Like, hey, this thing's not going so well, and I feel like you know, you left us in your rearview mirror, kind of waving to us back here. So show us some love, put a little more effort into these updates, and tell us what's really going down here on the refi. But guys, as always, drop your thoughts below. I'd love to hear how the rest of the folks are feeling about these. If you don't want to put it out there publicly, as always, you know, throw me an email. You can drop it in there. Give me a call. Whatever makes sense for you. But, guys, I appreciate you hanging out, following along this journey, and subscribing in for future updates. So, with that, guys, I'm Tyler Wayrung, and we'll catch you next time.